it seems like it's going to be a green day. Of course, we'll get you more reports and perhaps get a report of honor on Bandhan Bank's clarification too. 0.6% higher. We've made it back to the 21,600 range. In fact, inching closer to 21,650 as we speak right now. What's Bajaj Auto up to? They've announced the buyback worth about 4,000 crore rupees, significant premium to the current market price. But at the same time, the quantum of the buyback is not something that the street was anticipating, or smaller than what one would thought have come out. Bajaj Auto still holding higher by 4.5% as we speak right now. Bandhan Bank, by the way, is holding up about almost 2.5%. We'll shortly be getting our reporter as well and get in more details on this. There has been a clarification set out by Bandhan Bank and the stock clearly is reacting to that. Besides that, IRB Infrastructure, Tata Motors wherein the JLR wholesales volumes have seen a shoot up of about 27%. IRB Infrastructure toll collections have risen 26%. BEML after that near about 400 crore rupees order wins. That stock as well is going to come up for you on your screens, 2.5% of a move. There's Metropolis Healthcare as well. Core revenue business growth has been quite decent. And now I want to see Z because reports are indicating that the merger is likely to be called off with Sony. That stock has gapped down about 9% as we speak. What are the heavyweights up to? Reliance, HDFC Bank, ICICI Bank, SBI, they will come up for you on your screens next. Reliance hovering around the 2600 level. ICICI Bank as well has made a rebound. Still flat for HDFC Bank. Refuses to budge around 1665 odd levels right now. And SBI, which fell 2.5% in yesterday's weakness, that stock as well will come up for you on your screens. 1% higher for SBI as we speak. Aman, anything that you're spotting?
Well, for now, it continues to remain a fairly decent start, so no complaints whatsoever within the broader universe as well. You've got traction building up, in fact, a degree of outperformance for the mid and the small caps. While, of course, your usual suspects are under pressure, the likes of Z Entertainment on the flip side, Lemon Tree Hotels continues its up move, HPCL looking smart, IRB Infra in the green, and something like an Indiabulls Real Estate, along with IT stocks like Wipro, Infi, First Source, Info Edge. That entire basket is a buzz in trade. A smart breath. Let's find out the first trades from our chartist. Kunal?
So Info Edge is something which looks attractive. That's a stock which I believe is heading towards a breakout and would look to trade in the open.
All right, Nuresh, let's get in your first trade.
So continue to be defensive after the gap up. Buy on Power Grid, which looks a slow and steady move from here.
Let me take it across to Ankur as well, and he's picking up some communication from Bandhan Bank. Ankur, what's the latest communication like?
Yes, there is an audit which is being conducted in Bandhan Bank, and let me tell you, it is CGMFU, meaning the Credit Guarantee Fund Unit audit which is being conducted at the bank, and this is conducted because it has claimed more than 1,200 crores. Normally, as a procedure, when the claim is more than 1,000 crores, this kind of audit is being conducted. But let us specify to our viewers, it's not an RBI or a kind of forensic audit for the bank. Now, all these claims will be checked whether or not these claims are right because the amount is more. And after that, you may see that the bank has already indicated that they are expecting that 1,200 crores in next few quarters. You will see that after this process is completed and approved by the government, you may see this fund coming as a kind of recovery for the bank.
That's the view coming in from Bandhan Bank, clarifying that this is not an audit of the bank and they are confident that the bank will get the recovery of the claim that has been initiated, which is why you're seeing the stock price as well holding out comfortably in trade. It is only an audit of the CGFMU claim that has been made to the bank pertaining to the portfolio. All right, let's move right on. A special and big market voice, Milind Karmakar of Dalal and Brocha Portfolio Managers in conversation with Nikunj. Nikunj.
All right. The reason why I'm laughing at the introduction of the show itself is because my guest on the show is someone who's always happy, always blissful, always laughing. And some of the stocks, if I tell you where he's invested in, well, they'll make all of us smile because if you followed his advice over the years on buying good businesses, holding them, ignoring P multiples, to use them as the only yardstick to judge the true value of the business, well, trust me, you would have had a good run when it comes to investing in stocks like Trend, Indian Hotels, and even for that matter, names like Titan. So it gives me great pleasure to bring on board Mr. Milind Karmakar to talk about markets, themes, ideas, and where is he picking up spots in this market. So I guess the introduction was a fair summary of your philosophy of life.
Yeah,
Keep
sort of.
smiling, keep going.
Yeah, absolutely.
Bull markets, when Trent was at 100 rupees, you were smiling. Trent at 3,000, you're still smiling.
Yeah.
That's the philosophy of life.
That's the philosophy, absolutely.
So, for our viewers to smile and for them to laugh now, they perhaps need insights from you about markets, about valuations, and about how should you approach the market now. We are at that juncture where India is now a discovered story. We are at that juncture now where sliver of the market offers value. We are at the market now where 80% of the investors in the last 2 years, they've made double-digit returns.
Correct.
How would you map the risk-reward ratio for next 2 to 3 years for genuine long-term investors?
Okay. So, frankly, I thought you will ask this question. So I was doing some
Am I
math.
getting very predictable about it?
No. So I was doing some math and, over a very long period of time, markets have returned about 1.6 to 1.7 times the GDP growth.
Okay.
2018 to 2023, I think the GDP has grown roughly by about 60%.
Okay.
And the markets have grown by 100%. Okay. So yes, there is a slight, you can say, move ahead of times. But if you think that Indian economy will grow at the rate what everyone is talking about, which is 6.5–7% real GDP growth and about say 5–6% inflation, then we will have about 12% inherent growth in the economy itself. And that probably will drive the markets anywhere between 18 to 20% in the next year on year for the next 20 years. So next 5 years. So there is possibility that sometime it may stagnate. But overall, I wouldn't be surprised if the markets at least go up 2.5 times in the next 5 years.
2.5 times in the next 5 years?
5 years.
Okay. And you're talking about the index level here?
I don't know the index level, but it will be, that is what will, because that's just a number. So I am looking at, so if the index doubles, frankly, the market should go up 3 times. But I'm just giving it a bit of a discount and I'm saying 2.5 times.
Okay, so are you saying then, I don't want to get this one wrong because that clearly is the most bullish voice for us so far this year. We are a $4 trillion economy.
Yes.
If you feel that markets will go up to 2.5 times in the next 5 years, are you making a case that the wealth of the stock market could be anywhere between $8 to $10 trillion in 5 years?
Yes.
Okay. Now, if the market cap of Indian stock market has to go from $4 trillion, I'm still counting numbers, $4 trillion to 8 to $10 trillion, what will drive it higher?
So I think, because what happens is that when economy grows, everything grows. But I still believe that it will be consumption. I mean, I'm coming back to my theme because that's a theme where India has got a very long-term growth pathway. But again, just would like to reiterate that when I'm talking of consumption, it includes finance, it includes pharma, it includes FMCG, it includes retail, it includes hospitals. So all of these would participate and grow significantly because it's very simple. What we are consuming today, maybe 6–7 years down the line, rather what the GDP is today, 6–7 years down the line, we will be consuming that much. So that is the kind of opportunity which, and more, because people will leverage and things like that. So that is the reason why I think that it will be predominantly be driven by consumption, but within consumption, as I said, there are different sectors. So each of these segments could, like, frankly, if you see, banks have not moved at all. So I think banks could drive the index over in the shorter period of time for at least 1 or 2 years. So I think long-term consumption will continue to be the theme.
Okay, now if at $4 trillion, the stack is that you got Reliance right at the top in terms of a market cap.
Yeah.
Then you've got HDFC Bank.
Correct.
And HDFC put together right top there. So if I look at the stack in India, we don't have a single $500 billion company.
Correct.
We have only 1 or 2 companies which have a market cap which is north of $250 billion. Yeah. So if you have to go from 4 trillion to 8 trillion, what could be the pecking order in terms of the large companies and how large they could become? Do you think India could get a $1 trillion company in the next 4 or 5 years?
So I wouldn't speculate on which company could deliver that, but it will definitely be in a banking space. Okay. That is what I think will happen.
Okay. Do you think that if the economy has to go, the stock market wealth has to grow again from 4 trillion to 8 trillion, it could be driven by new companies, new themes and new sectors, because there has to be some wealth creation of $500 billion, 500 billion to $1 trillion, which has to happen, which today we cannot foresee.
No, it's possible. So it's like this, that so if we divide the market into two parts, there will be this entire market which will grow 1.5 to 2 times. And at the same time, there will be some of the companies which can drive, which can go much further. So okay. Yes, that is possible, but that would, in all probability, would be in mid caps.
Okay. Let's look at the real outperforming sector of last 12 to 18 months. You add a prefix PSU, add a suffix India or PSU, those stocks have done rather well.
Yeah.
2020, there were the ugly ducklings. Nobody wanted to buy PSU stocks with a Bajaj poll. They are now the darlings of the market. Do you think this is just mean reversion, or the way companies in the government stable were doing business versus the way they will do business? Markets are excited about it and the markets are just voting for rate of change.
So I think that they will do far better than what they have done earlier. If you take a 15-20 years view. But whether they, in terms of market cap or in terms of price, whether they will give the kind of return in the last 2 years, that I have my doubt.
Where is value in this market according to you?
Sorry?
Where is value in this market?
Value is in banks. There's no two ways about it. Definitely value is in banks.
Okay. When you say there is value in the banks, some would also argue back and say that, look, interest rates have peaked out. Cost of liability or the war of liability continues, and there is a disruption coming from the fintech space.
Yeah.
When banks were earlier making money by transaction, now UPI has taken over. Fee-based income is actually getting challenged because of fintech and buy now, pay later kind of a model. So optically, banks are the best play on economic growth. But do you think somewhere their earnings could also get jammed largely because of disruption and the new RBI guidelines?
So yes, in the shorter term, maybe there could be some kind of a slowdown, though I don't believe that will happen. Because if you're banking on a rising per capita income, say from $2,500 to maybe $6,000 in the next 8 years, in that case, I think the demand from retail on banking side also will be huge, even for mortgage loans, or even for, not only clean loans, but also for mortgage loans and a lot of other things. So I don't see any reason why banks should slow down, because simultaneously we are also seeing industrials, the new capex cycle starting. And that will also drive growth. However, I don't think that there will be a significant demand from industries for large loans in banks, because if the markets are vibrant, maybe they will come to the market. But yes, it will definitely help, because banks have a solid balance sheet, so have the corporates. And because of that, I think there will be a demand from the corporate side as well. But it will be ultimately retail which will drive.
If I take the clock back 5 years ago, there were two banks which were top of the pedestal, HDFC Bank and Kotak Bank.
Yes.
The Indian banking sector was in a mess. PSU banks were getting recapitalized. Yeah. Large banks like ICICI Bank and Axis Bank, they had their own issues of leadership. So two banks they held out and they commanded disproportionate amount of premium.
Correct.
That novelty has faded away.
Yeah.
So do you think now we should look at banking sector in the same breath and we should not differentiate between PSU and private?
I would still give more weightage to private sector banks.
Why is that?
When it comes to retail lending, the PSU banks have still not got their act right, and it will be some more time before they get their act right. And that is the reason why I think private sector banks will probably be better off as compared to the public sector banks.
Who has the right to win then? Will the large private banks become bigger? Or the small private banks will also catch up? Within private, who has the right to win?
I think it will be across the board, but the larger ones will have a better reach, so they will definitely become bigger.
When you look at a stock like HDFC Bank, they've done all the right things.
Yeah.
Merger has gone through, cost of liabilities coming under pressure.
Correct.
At that large base, they're compounding in mid-teens. They're getting more than 20% market share of the fresh CASA which is getting generated. Everything is going right for them. but nothing is going right for shareholders. Stock chalta hi nahi.
So sometimes it also happens that a stock stagnates. I remember even trend between 2013 and 2017 didn't go anywhere. But that doesn't mean that the business was bad. Business was good. But probably it had run ahead of times, or probably people were not willing to buy stocks at a higher P. But things change. And I think that the same thing will happen in banks as well, including HDFC Bank.
The fact that trend has been an outlier for you,
Yeah.
and a lot of our viewers must have benefited from that by simply following your advice. I just want to understand your thought process there, because you bought Trent, I think, 20 years ago.
Yes.
Irrespective of the twist and the turns of the economy,
Yes.
you decided not to sell Trent. You
Correct.
did not sell when there was TMT bubble. You did not sell when there was 2008 crisis. You did not sell when there was taper tantrum.
Absolutely.
Trent was never cheap as a stock.
No.
It was always 40, 50 times, even in the worst of the times. But what gave you conviction, A, not to sell? B, what gave you conviction not to sell even when it was not growing? Because there were some lean patches for Trent.
They were. So I used to keep meeting Trent. Again, the idea was not to get any insider information. But
Routine.
The basic thought was that the logic by which we had invested continued to hold. So their focus was very clear that they will grow only when they have got their business model right. And their focus was very clear that offer value to the customer and the customer will come in. Like, I'll give you an example. Like, way back in, say, 2002-3, when Trent was only three stores. And if you would go to a West Side store, in all probability, you would get a shirt for a 200 rupees.
Are you wearing a Trent
time.
shirt?
Sorry?
Are you wearing a Trent shirt?
No, not today.
Okay.
Not today. Let me clarify.
Okay, you would get the shirt for 199 rupees.
Yeah, at that time.
Okay, this is 2003.
Yeah. Now, that time the India's per capita GDP was about $430.
Yes.
Today we are at about $2,700. If you go to Zudio today, you will still get a shirt, a similar shirt, for 200 rupees. Now the issue there is that, yes, maybe that time it was 100% cotton, this will be cotton plus something. But they have been able to maintain the price point. And that's the beauty, because then they have merchandise for every person who enters the shop. So when India's per capita income has moved up from $430 to $2,700, even then they have a price point for someone who may be at $430. So that is the kind of
They've got the
business
customer
model
and the price point and the supply chain right.
and the supply. So I'm coming to that. So supply chain is the key. Price point is also key. And to grow only when you get your business model right. They have done exactly the same thing they did with West Side, and they are doing the same thing with Zudio, and I think they will do the same thing with Star Bazaar as well.
Okay. We're discussing a thought here, and I have just one more follow-up question on the Indian retail industry. The fact that you decided to invest in Trent was also at a time when Future Group was expanding.
Correct.
Reliance Retail got created.
Yes.
Aditya Birla Fashion moved into this acquisition spree.
Yeah.
You decided not to really move to other corporate giants who had the same promise and the same
Correct.
appeal.
Correct.
What gave you the option not to bet on Future Retail or Aditya Birla Fashion or Reliance Retail?
One, of course, was that Trent was betting on private labels, and I knew that private labels have done well globally. That was the first thing. Second was that they had decided to grow without taking any debt, because retail is one of the toughest businesses and with not as high margins as manufacturing. So you need to have your finances absolutely tightly controlled, and that's what they did, and that was the reason why I decided to invest in Trent and not in other companies. Reliance, again, retail, the issue was that it was sitting in another listed company where predominantly it was petroleum. Okay. So when I was looking at retail, it was only two, Trent and Titan, which we decided to invest in.
The lovely book, I'm sure you've also read it, book from Pulak Prasad on what to do, what not to do. Be extremely lazy, not just lazy, be extremely lazy.
Absolutely.
Is that your investment philosophy, that just be lazy, not just lazy, but extremely lazy? Buy a stock, just don't worry about it after that.
So I would put it, especially for a retail investor, I would say that yes, you need to be lazy, definitely. But at the same time, you also need to keep, returning back to your investment thought and just confirm that the investment thought continues to hold in the company. As long as that is there, you don't need to do anything if the prices move up and down. No, not at all.
Between 2022 and 2024, it's been 2 years now, have your top 5 holdings changed?
Not really.
Okay, why is that? Because markets are up 50-70%.
They continue to do well. Trend, so it's like this.
What are your top holdings then, just for disclosure purposes?
Trend, ICICI Bank, Titan and Syngene.
Okay.
4 I remember, the 5th one I don't remember.
Okay, so top 4 holdings was same in 2022?
Yes.
Okay. I'm not getting into a stock-specific conversation, but when you look at a company like Titan, when you invested in Titan, it was a watch company.
Yeah.
Now it is a jewelry company and they're migrating into other businesses. What do you think they've got it right? Because again, the jewelry business in India is highly competitive.
It is highly competitive. But again, so we entered into Titan at that point in time because it had gone into jewelry.
Okay.
So that was one of the main reasons. The second was that, of course, their focus was trust. So they started those machines where you could go and test the purity of gold. Because ultimately buying gold is all about trust. So people buy from a neighborhood jeweler because there is trust. So that is the reason why they could attract a lot of people to their stores. And I think that's what was the main winning factor. And of course, then comes the brand and then comes the designs.
So when stocks, they grow at what could be called as P multiples which are above averages. For example, Trent now is trading at a P multiple of 100 plus. Titan must be 40, 50 times 1 year forward, depending on the estimate you look at. You don't get the temptation of switching, selling, buying something which is cheap.
So as long as I don't see any business which can grow faster than them, that is one. And frankly, when it comes to Trent, the P multiple, I think one needs to go through the balance sheet. One needs to analyze that because of Ind AS, the changes which have come in, when future liabilities you have to adjust by amortization and interest. So if you adjust for that, it may not be at such a high P. It will still be at a high P, but not as much as 100 plus. So that is one. And second is that as long as they are growing at 40-45%, I don't think there is any problem, because at that rate, the P multiple can collapse if the price remains same, which it doesn't, because if they continue to grow, the price also goes up.
Why do you think Indian pharma sector has a lot of scope for re-rating?
So yes, I think that in future it will be Indian pharma sector which is likely to do very well, because as I think I have said that earlier also, that long back I had met Dr. Reddy of Reddy's laboratory and I had asked him, because that time their focus was exports. I said, why not India? So he said that unless and until India's per capita income grows significantly, where people can start affording medicines, India will be a slow growing business for them. And that's the reason why they are focusing on exports. But now I think things are changing. Our per capita income has gone up. And because of that, I think companies which are focusing on India also should do very well. And that's the reason why I think that overall Indian pharma would be a sector which can be worth looking at.
So should one then look at MNC pharma companies also, because they are a pure bet on India? Because for all other companies, whether they have, whether it is Cipla or Dr. Reddy or for that matter Sun, either they have presence in Europe or in US or in both, and the third one is Africa. So how does one differentiate if one has to bet on the Indian pharma per capita growth?
So I agree with you that companies which are focused predominantly on India should be on your radar. You should look at them. Look at the products in which they are in, because that is very crucial. Ultimately, it's diabetes, cardiovascular. These will be the sort of segments which will do very well in India as the per capita income goes up. So anti-infectives will also do well, but predominantly it will be diabetes and cardiovascular which should do well. So look at those companies and invest in them.
When we spoke last time, you said you were bullish on manufacturing, and you said you bought into railways.
Yes.
You bought into EMS.
Sorry?
You bought into electronic manufacturing as a sector.
That's correct.
Are you still betting on EMS?
So EMS is one portion of our overall investment. We are invested in some other companies also, but predominantly we are looking at those companies which can be, which can benefit out of gases, which can benefit out of power sector and which can benefit out of railways besides EMS.
Do you think the manufacturing sector in India will grow faster, or the consumer sector in India will grow faster?
I think if you are taking a 10-year view, in all probability, consumer sector will far surpass the manufacturing sector. But in the shorter term, it's possible that manufacturing sector will grow faster.
You've been holding on to insurance for a while now, and that is one space where a lot is changing.
Yeah.
I understand the big picture in terms of, okay, Indians will need better healthcare. We can afford better healthcare that will take care of your health insurance. We value safety of our life after COVID, which means we will also see more and more, migration happening towards term insurance, which is also taking care of in your India ones. But the Indian insurance sector, Mr. Karmakar, is going through a tough time. New entrants, consolidation, LIC suddenly, waking up and taking giant steps forward. What is your view on insurance, which for our normal viewers is a complicated sector to understand?
I agree, it's a complicated sector, but you will have to take a bet which is based on what kind of growth can insurance companies deliver over a longer period of time. Because ultimately, it's all about affordability. So, if ultimately you have to afford hospitalization, you have to afford medicines, then you need an insurance. And that is where I think the growth in insurance will come in. Yes, we are holding it for a pretty long period of time, and there have been underperformers in our stock, in our portfolio. But we'll continue to hold because our thought process is simple, that if there is growth in this sector, we'll continue to hold it.
You like consumption, but you've not used the word luxury consumption. Why is that?
I think the per capita income needs to grow up further. If it grows, we'll definitely look at luxury consumption. I mean, we are indirectly holding, so we are holding trend. So we are indirectly get benefited out of Zara. But Zara in India is a luxury consumption, not globally. Globally, it's a mid-level fashion kind of thing. But yes, that's what per capita income growth will happen. Once per capita income growth goes up, then probably we'll look at luxury consumption also.
They say that when consumption of per capita reaches $3,500 to $4,000 per person or per capita, you could see a binge uptick in consumer spending.
Yes.
So where do you think excesses in the consumption space will get created?
I think it will still be apparel. Apparel and probably ancillaries. So, but apparels predominantly. It's very easy to buy an apparel.
Have you resisted your temptation not to buy into any of the consumer tech and fintech stocks?
So we have bought one into food tech recently, but not consumer tech and neither fintech, because we are still looking at them, and we think that banks are equally good fintechs. So we are, and of course there are a couple of NBFCs who are using fintech quite a bit. So we are invested in that.
What prompted you to change your heart to buy this food tech company?
Positive cash flows, at least to begin with. That's what I had said earlier, that if they show me a positive cash flow in one quarter, I'll buy.
But is that a basic criteria for you to buy? You will only buy companies if they have a positive cash flow?
Yes.
Let's talk about IT, and this is where I think the jury is still divided.
Yeah.
Old timers would say, look, Indian IT companies have migrated the curve of Y2K. They came as real winners when the enterprise platform adoption happened. They were the outliers in terms of gaining market share and maintaining the relevance when smack and digital also was at play.
Yeah.
That's the naysayer who's saying that don't worry about AI.
Correct.
The new theory is that AI is actually not just a wave. It is the way how the sector now would be, in a sense, doing business.
Absolutely.
What is your thought? Do you think this is like a temporary disruption, or the Indian IT sector now, the foundation has got shaken?
My view is that they will need to adapt to AI.
Can they do that?
They will, sorry?
Can they do that?
I don't know. Jury is still out. So I really don't know. But that's the reason why we are cautious on IT. We will continue to be cautious and take it one at a time.
I don't see too many bets, at least in whatever information in the public domain is available when it comes to EVs, or for that matter, energy transition. Aren't you betting on these mega themes?
So yes, we have one gas company in our gas in the sense, one which is not gas in sense gas, but the largest industrial gases company, which is Linde, we have in our portfolio. But besides that, in EVs, we are playing it through Exide, which is there in our portfolio. But besides that, we have not taken anything.
A lot of naysayers, I will not use the word naysayers, but this now seems to be the consensus view that there is a bubble and there is a lot of trouble in small and mid-cap stocks. What are your views for that?
I agree. There is a bubble. It's not a bubble, but yes, there are certain things like old names which I have never heard, which I used to hear maybe in 2002-3, suddenly people calling and saying, what do you think about these companies? That's what worries me. Sometimes there is a word chip in a company and then they say, this company will do very well because it's planning to, get into chip manufacturing. It's not so easy. So I think there are excesses in mid and small caps.
And I remember in 2000, real estate companies had become IT companies.
Yeah.
In 2008, those IT companies had become real estate companies again. And those IT companies are becoming chip companies. Yes, one there was both. And now they're becoming chip companies now.
Yeah.
So manufacturing is the space where everybody is excited, but the reality would be very different.
Absolutely.
I'd like to, draw your attention to something which you've always endorsed, which is think long term.
Sorry?
Think long term.
Yeah.
In the near term, markets will always, swing because of sentiment.
Yeah.
So if one has to look at the pendulum of the market, where do you think there are excesses in the market? And where do you think there are still opportunity in this market?
I think mid and especially small caps, there are excesses. I won't say they're across. So it may continue for a long time because I've learned that during the software boom that when you think there are excesses, the prices can grow 4 times from there. So I'm not a person who can say that, okay, don't go there. It's individual choice. But as a fund manager or as a person who is managing money in trust, I would not get into that at all.
Well, those were thoughts from none other than Milind Karmakar. And one of the few interesting points that he made was also about investments in healthcare as well as insurance, given that per capita income is on the rise and therefore a need for higher and affordability for better insurance as well. Which brings me on to my next guest and Narayana Healthcare. They've got the latest win. They've received a health insurance license. So let's chat a little bit more about that. We've got Mr. Devi Prasad Shetty himself joining in on the show right now. Dr. Shetty, great to have you today on the show. Thank you so much for taking the time out. Tell us about this new license now for insurance. You've got it within 6 months of submitting the application. Did you anticipate that? How is it that you're going to manage healthcare insurance? And how different would it be from the regular health insurance that we all take up?
First of all, I want to thank IRDA for the remarkable speed at which they have cleared our license. It used to earlier take over 1 to 1.5 years, more than the waiting period. They would never, around many years ago, I tried to see whether I can apply for a license. And I didn't even get a chance to talk to them. Things have changed in IRDA. It is run by very dynamic, very progressive people. So we got it in less than 5 months, not 6 months, less than 5 months. I think it is the fastest health insurance license anyone has got, thanks to them. But it's an exciting opportunity, and this is the only way we can transform Indian healthcare. This is the way forward, I have no doubt. We should start talking about not universal healthcare for free for the citizens with the taxpayers' money. We should talk about universal health insurance for everyone. This should be our slogan.
And it's much needed as well, right? And I stand corrected on 6 months. You're saying it's less than 5 months that you got the license. But to the point that I was, making earlier, how is it going to be different from the other health insurance schemes that are available?
See, currently the health insurance companies they work like a financial intermediary, which you get admitted to the hospital, you produce a bill and they pay the money. We want to be different. We want to be like a managed care organization, like a Kaiser Permanente of US. wherein we evaluate all the members. We have all their data with us. We manage their primary care. We manage their secondary, tertiary care. And we would like to predominantly work like custodians of healthcare rather than just a payer for the treatment. We want to know the status of the healthcare. If there is a diabetic patient, we are not going to refuse care. We will offer them the care, but we will ensure or help the person, hand-holding them and making sure that diabetes is controlled. Essentially, we want to ensure that people do not fall sick. Then the conflict of interest will be addressed. Today, about 16-17% of the heart surgery done in India is done by us. Today, we have no incentive in preventing people from falling sick. Once we become a health insurance company, it is better for us if people don't develop a heart attack. So the whole problem of conflict of interest is addressed. This is the way we want to move forward.
Well, I hope that aim is achieved. But tell me, by when are you looking at beginning the operations when it comes to insurance? Considering that you've got your license itself at breakneck speed, when do we see you get going, and which geography would you target first?
Yeah, our team is all set, and they are hopeful that with next month itself, we'll be launching our products. And we initially want to concentrate on city of Bangalore. Then we would like to look at Calcutta, where we have a large presence. So we are not going to cover, it's not going to be a pan-Indian insurance company from day one. We want to do it in a gradual manner. We want to learn. We want to make all the mistakes at an early stage when we are small, learn from it, then progress.
Fair enough. Morning, and I wanted to ask whether or not there is going to be a correlation between your hospitals and the insurance company?
Yes, there is a major correlation. Definitely. This is the advantage of hospital becoming a health insurance company, wherein there will be a lot of benefits our members will enjoy because we are a healthcare providers. So a lot of benefits they get in terms of having access to us around the clock. And we have hospitals across the country, and we have large number of nurses who are extremely well trained, and our services are available to our clients around the clock. Yeah, there are many, many benefits.
And given that insurance companies are, demanding a hospital regulator, I don't think hospitals are in favor of that. Can you just tell us as to, what the stance is, the latest stance is on this?
See, essentially, I'm not saying that today we have a very interesting scenario wherein there are three stakeholders in healthcare. We have hospitals, we have health insurance companies, we have patients. And there is no trust between these three important stakeholders. So I'm not saying who's right and wrong. I guess everyone is wrong and everyone is right in their own way. But current, the relationship equation is not conducive for a healthy growth. So it has to change. And there are many things insurance companies are trying to do. There are many things hospital service providers like us are trying to do. So there is no one solution. There are multiple solutions. And we are thinking of one solution. Maybe we walk in this path and see over a period of time, we will know who's right and who's wrong.
The other thing, Dr. Shetty, I wanted to understand is, cost of treatment is going up and exclusions by insurance companies is also increasing. I mean, the key thing for early health insurance is that you've got to be hospitalized for at least 2 days to get that claim back. How different are you going to be with your health insurance, catering? Because I mean, for instance, even angioplasty, MRIs as well cost, even though the patients are not hospitalized for the same.
See, as I said, since we are going to offer primary, secondary, and tertiary care, we are going to take care of every aspect of healthcare. But one thing for sure, we are not. I wouldn't be able to give you the minor details because I do not have the access to that information yet. But all I want to say is that the moment we give you a health insurance, you are covered for everything from day one. There is nothing like a cooling period of 1 year, 2 years, none of those sort. So we will be covering everything. We'll be covering the outpatient, with our outpatient program. We'll be covering inpatient services. And when patients come to our hospital for the treatment, there won't be any co-payment. This is the plan our team has. Yeah. It's going to be dramatically different than what is available today.
All right, appreciate your time. Thank you for joining in and giving us a view on now how you're looking at insurance as well being weaved in to Narayan Health with that insurance license. All right, a quick check-in on the markets at 21,616. It's holding out by 0.5%. You've got the broader end of the market that's somewhat tempered off from the early morning outperformance that we witnessed. But nonetheless, that breadth continues to remain positive. It's only media and largely owing to what Z Entertainment is doing in trade today with that 10% gash that's under pressure. But other than that, IT, real estate, autos, even the metal sector, all quoting in the green. In fact, I'm just going to identify some buzzers within the broader universe that are seeing an uptick. IRB, Infra, Trident, Endurance Tech, as well as Cochin Shipyard. But time to put the spotlight then on FMCG. What is the outlook when it comes to rural growth slowing down, inflation woes, as well as who is going to be some of the key beneficiaries down the line? Abneesh Roy, who tracks the sector very closely, now joins in from Nuvama Institutional Equities. Thanks so much for taking time out and joining in. I'll start off with the latest news that we had just yesterday that companies, a lot of these FMCG companies have undertaken a grammage increase in order to pass on the raw material price benefits. How are you looking at that, allowing them to help in volume recovery?
Sure, thanks for having me. So yes, it's a positive development. We see this as two reasons. One, of course, local players in select FMCG categories have been an issue last 2 quarters. And we always see pan-India players, eventually they get back that market share. So we would see the grammage addition, the price promotions, the cross-subsidization of the lower end by the higher end by the big companies. That is leading to a fight back against the local players. So we have seen that earlier in tea, the lower end detergent, biscuits, edible oils. We have seen this issue that local players have taken some market share, but eventually the large players win back that market share. So we see that in next 2 quarters, the local player issue will go away. Second, of course, yes, rural volumes have been disappointing in our view. Q3, you will see most of the companies see flat to low single-digit volume growth in the rural, while urban will be growing faster. Even Q4, we don't see a big recovery in rural currently. Our sense is the recovery will happen in FY25 based on the 1 lakh crore kind of election spending, government stimulus, freebies, etc. In terms of the acreage, also in terms of the Kharif and Rabi, it seems to be going the right way. The only thing which is needed for next year is no El Nino. We have analyzed the last 20 years data. So 2 back-to-back El Nino years are a bit rare. So if the monsoon is normal, we'll see the rural recovery start in FY25. Currently, our topics for this results will be essentially United Breweries, Nestle, Bajaj Consumer, Tata Consumer, and Dabur also saw good performance. The weak performance are essentially from Marico, Imami, ITC, Britannia, etc. And mid-tier performance will be from the rest of the companies like Hindustan Unilever, Colgate, United Spirits, etc. So currently, we'll be a bit cautious in terms of the rural demand.
Abneesh, the other thing I also wanted to understand, it being an election year, there is, of course, that vote in account and then the budget as well thereafter post-elections. Do you see higher government spend and maybe that could aid rural recovery much more meaningfully?
Yes, I would expect that. Already, if you see Narega, the budget outlay has been breached and government is giving more support. So that's a positive thing. We also saw that the free food subsidy for almost 80 crore Indians, that has been extended by 5 years. We also saw that now the cooking gas and the diesel and fertilizer subsidies have been increased in most states and even by the central government. So yes, definitely government is taking a lot of actions to overcome and to help the farmer. Definitely in terms of the El Nino, that was the spoiler. We saw some green shoots in Q1 FY24, but that got negated because of monsoon deficit in UP, Bihar, etc. And there were floodings in some of the other areas. So that has been the issue. The other issue has been inflation in medical, education, telecom bills for the farmer. That is taking away some money from FMCG lower end. The higher end, it's not a problem, but the lower end, the inflation in education, medicine, and telecom bills, etc., is leading to more outlay there.
Fair enough. What's the outlook then in terms of the budget? And in terms of apart from that, just talking about regional players as well, because they continue to dominate. Do you think that the competition will continue to remain fairly stiff?
Yes, sir. Local player competition will continue in Q3, Q4 in segments like biscuits, lower end detergent, edible oil, tea to an extent. But after that, what will happen is the national players will win back that market share in FY25. We always see this happening. So last year, the local players' gross margins were very low because of high inflation. And when the deflation in key raw materials happened, they had more ability to spend on advertising, spend on promotions. So this is a temporary effect. In terms of the budget, this time ITC, we don't see much of an issue because February budget will be a non-event. The real budget will happen post-election. But ITC December quarter will be soft because last year ITC's cigarette volumes were 5% quarter-on-quarter higher because of the budget expectation of a tax increase, which eventually was very mild. But this time the budget will be post-elections in July, August. So that's why ITC, the weak volumes will be there in Q3, which we expect in Q4, slight recovery. So this is how we see in terms of the budget impact.
Particular, if I have to delve deeper into, Abneesh, what can be anticipated from volume recovery? What is it that you're penciling in for what this quarter is going to report, and what's the visibility now going forward across categories and companies?
Sure. What we are seeing is the segment which is doing well in December quarter and possibly even March quarter will be beer segment. So United Breweries, we expect high single-digit volume growth in Q3. This is higher than most other FMCG volume growth. Even United Spirits, our senses, the P&A volume growth will be 3-4%, while the popular will see a double-digit volume decline. So beer seems to be growing faster. There's a market share gain for United Breweries also. So that is one thing which is there. Otherwise, in terms of the updates which have come in terms of Marico, Colgate, Dabur, Godrej, etc., we like the update from Dabur. They have seen good international business growth, even in India, except the winter care portfolio because winter was mild. Rest of the portfolio for Dabur has done well. But Marico, if you see, because of the hair oil, local players slow down, higher competition from Dabur and Bajaj Consumer also. Coconut hair oil has been a bit weak. Vaho also has been weak and Saffola also weak. Plus for Marico, international business has also now slowed down to a 5% kind of a growth. So our topics will be essentially United Breweries, Nestle, Bajaj Consumer, Tata Consumer, and Dabur. From a Q3 results perspective, Bajaj Consumer and Indigo Paints, these two small companies will see good numbers in December quarter. Bajaj Consumer, because of the festival-related benefit in Maharashtra, and Indigo Paints is taking a lot of proactive steps going into waterproofing, expanding feet on street, etc. So these two companies will see good numbers in December quarter results.
I know you spoke of those individual categories, but what about food in particular? How do you see like the QSR plays and some of these platforms as well performing? Food tech as well, if you would like to share?
Yes, good question. So in fact, QSR slowdown started last year in December quarter. So initial expectation was that because of base effect, the December quarter results should be a improvement in terms of trend. Unfortunately, that has not happened. So we are still seeing that the same store sales growth for a lot of the QSR will be a low single digit kind of a number, which is not very different than earlier. In spite of World Cup being there in December quarter, in spite of base effect now catching up from a positive aspect, we are not seeing that because there is more competition between the QSR. There is a lot of expansion by each QSR, and definitely consumer is going beyond QSR and sampling other kind of formats also. So that is the reason why we continue to see very limited same-store sales growth recovery for QSR. Slight gross margin expansion will happen because milk cost has cooled down. But because of lack of operating leverage, EBITDA margin expansion will be fairly limited. So in retail, we continue to remain positive on trend. We saw very good numbers by Titan. So that is something which we continue to like. So these are the two names which will see good numbers, and in spite of valuations being rich, we'll see the compounding effect in Titan and Trend.
Abneesh, can't help but talk to you about Z. The saga continues, and now reports are indicating, source base of course, that the deal is called off with Sony.
Yes, it remains a saga even after 2 years. Only two things I would like to say on that. One is these kind of news articles have come earlier also. Then we see that the opposite thing happens. So investors of Z would want to have that kind of expectation. Currently, in our view, it's a 50-50 probability of deal happening or not happening. If the deal doesn't happen, it is negative for both Z and Sony because individually their market share will be too small, especially given Disney and Reliance Industries are coming together and they'll become very large in terms of market share. So Z and Sony, it is imperative that they go ahead. Otherwise, they'll become irrelevant in the next few years. Z stock has come down sharply today. This was expected given the news flow which happened. But definitely, in our sense, the talks are still going on. And earlier also the news articles have come and then nothing happened. But definitely the delays are concerning. And in our view, the probability of deal happening or not happening has gone down because of so much of delay. In our view, this is not just a disconnect on CEO designation. I think there is more to it. There are some issues which seem to be still unresolved. So those are the issues and clarity which are still awaited. If the deal doesn't happen, there could be more pressure on Z stock because of the reason which I mentioned, that Reliance and Star are coming together and they'll become a very dominant player. So if the deal happens, this stock could definitely re-rate to 350 plus also very soon because all the approvals have come. So it's a 0-1 event, but it's very unfortunate that after approvals also, there is so much of a disconnect between the two players and both are going to see a win-win if the deal happens. But definitely currently it's a 50-50 probability in my view.
Okay, that will spell trouble for Z Entertainment and Sony. Thanks so much for giving us your insights on FMCG as well as touching upon media, given that it's a very pressing issue and the stock is reacting. Good to have you on board. All right, let's shift gears then and move on and put the spotlight then and talk a little bit more about what's going on with Goldium International, to talk a little bit more about how lab-grown diamonds are only gaining more traction, and for the company, what the outlook is when it comes to their margin and growth as well as expansion. Anmol Bhansali is now the MD of the company, now joining in on the show. Good to see you and good to have you on board. And I think it's a pretty pressing question given that there's this constant debate of lab-grown diamonds versus natural. And can you just give us a sense as to what the outlook is in terms of pricing, in terms of quality, and this major shift that we're witnessing to lab-grown diamonds?
Great. Thank you so much for having me on the show. Before I answer your question, I just want to clarify some things about Goldium. So Goldium is a design-led manufacturing and export company that offers value-add finished jewelry to large US retailers and retailers around the world. So we are not a diamond trading company. We are not a company that does plain gold and plain metal jewelry. 100% or near 100% of what we sell is diamond-studded, value-added finished jewelry designed in-house at Goldium and manufactured here as well for large US and other global retailers. Over the past 35 years, we have been a company that has always focused on net profits and margins. Case in point is that we have one of the best margin profiles in our entire industry on the export side and have always focused on ROE within all the businesses that we choose to do. Over the last few years, we also have had a robust shareholder return program. Specifically, I wanted to mention that in the last 6 years, Goldium has distributed over 225 crores in dividends and buybacks to shareholders. And despite this cash outflow, we today still have more than...
Anmol, if I may interrupt you there, the thing is that we're a bit short on time and we want to get straight to business and talk about the outlook. So let's just begin by talking about this huge competition that we're seeing from unorganized players as well within the lab-grown diamonds gaining traction. Just your take?
So yes, we see at Goldium that lab-grown diamonds is certainly gaining traction. 2 years ago, the product would be maybe in single digits as a percentage of our sales. Today, it's in high 30s, and we think that by the end of the financial year, it could even go up to 50 and cross that as well. In the US, there is phenomenal traction, specifically in the middle income segments that Goldiam caters to. At today's prices, it's almost become a no-brainer to choose lab-grown diamonds over natural diamonds at those particular price points.
All right, fair enough. That aside now, let's give us a sense in terms of your company, because natural diamonds constitute 66% of your revenue. I know you spoke about the mix from lab-grown going up. So what is the overall mix going to be, and how do you see that panning out over the next few years?
So Goldiam, as I mentioned, caters to middle income segments, largely in the US for the time being. Given that this segment has been so impacted by inflation and the general problems of wage inflation, and that they've never really been able to afford large-sized natural diamonds, the shift with lab, given where prices are, has been almost extremely clear. So the transition in the last 2 years has been huge, and we see over the next few years, lab-grown diamond jewelry will be a majority of our sales as compared to natural diamond jewelry, potentially even crossing 50% within the next 3 to 4 quarters.
Anmol, as we understand that you've tapped into new geographies as well, right? And you have ventured now into Middle East. Tell me, how's that market absorbing lab-grown versus earth diamonds?
Yes, so we have ventured into expanding our sales mix and strengthening our sales profile. Middle East and Europe are two regions with which we've hired sales professionals in order to cater to retailers in those markets. Lab-grown and natural are both doing well there. Of course, I think natural has a higher share in those markets for the time being. But the introduction and adoption of lab-grown, even in those markets, is fairly clear, and we're very excited to see growth over there as well, along with India in the future.
But tell me, how are the margins when it comes to lab-grown diamonds? While of course penetration is still at an early stage, and like you're saying, as of now, even in the US, it's the middle income segment which is more adopting to lab-grown as opposed to earth diamonds.
Right. So great question. At Goldiam, we are one of the only jewelry companies that has backward integrated into growing our own diamonds. So through Eco-Friendly Diamonds LLP, which is a subsidiary of Goldiam, we grow a significant portion of our diamonds in-house as well. That empowers us to have a higher margin profile in lab-grown, which is in its mid to high 20s, as opposed to natural diamond jewelry, which is in the high teens as a EBITDA margin profile.
One day, Anmol, we'd love to come to your labs and actually see the making of a lab-grown diamond.
We'd love to host you, and I'm sure and we'd love to showcase all our jewelry that we do, both natural as well as lab-grown. And I think it's fairly clear with the type of jewelry that we do, and the way we present it, you'd see the consumer shift even in the product that we showcase.
Definitely take you up on that. Aman and I are coming soon. Okay, good speaking with you, Anmol. Thanks for taking the time out and joining in.